Now, when you're trying to figure out what type of chart you should use, you need to keep in mind that there are different types of scales. Now, the first type of scale is known as linear, and this is the most common chart form. And what this means is that the price axis and the time axis are on equal plots. The second type of chart that you want to use in the crypto markets is known as the semi-logarithmic. And what this does is it's going to show you a percent price change that's the same all the way up on the y-axis, and I'll demonstrate in a second. The rule of thumb that I use for crypto markets is if there's a price that moves over 100%, I want to use a semi-log chart to identify that price. And let's take a couple look at a few charts to see how this works in practice. Right here, you're looking at a Bitcoin chart. This is Bitcoin on the Bitfinex. And you'll notice this is not a candlestick chart right now. This is actually an area chart. So the area chart is basically a line chart with a shaded area below it. And this is a good way of illustrating a longer-term chart trend. It starts in 2015, and you can see this is about 3 years worth of data. And most noticeably on this chart is that the y-axis moves up in a linear fashion. Okay, so from 0 to 2000 to 4000, all these numbers jump in the same arithmetic formula. Now, you'll also notice that in 2017, prices looked like they skyrocketed in Bitcoin. I mean, the market started rallying throughout the first half of 2017, and then they really took off. And that's true, prices did jump. But if you think about things on more of a semi-log area, this rally is no different than ones we've had in the past. In fact, not much different than ones we've had in the last few years. So a semi-log chart on the y-axis gives us a percent change in prices. So if you start here at 210 and move up to, let's say, 420, which would double it, it's equivalent from moving from 2100 to 4200 on the same graph. You can see the distances are roughly the same amount. And this will show us that Bitcoin, even though the move has looked parabolic on an arithmetic chart, it's not much different than the trend has been since all the way in 2015. So it doesn't look as dramatic on a semi-log scale as it does with an arithmetic chart. And it's important to look at these semi-log charts because they'll notify you and show you that these trends tend to be the same over time. Even though something might look parabolic, it's happened in the past and probably will happen in the future. Now, when you're looking at a price chart, it's important to keep in mind, you're not just looking at the asset that's being charted, you're looking at the behavior of the market participants. And we've seen over time these market cycles come and go, and they really resemble other market cycles of the past. There are a couple different ways that you can look at a chart or identify price trends. You've got line charts, bar charts. Today specifically, in this course, we're going to focus on candlestick charts. Now, candlestick charts have been around for a while. They originated in 1600s in Japan to study price changes in rice. In the early 90s, they were brought to the United States by a guy named Steve Nissan in his book titled Japanese Candlestick Charting Techniques. Now, let me give you the quick basis of them. There are red and green candles. Sometimes these can be represented as hollow bodies or full bodies. But essentially, a candle shows you where the price has gone given a specific period. So if I show you a daily chart or a 1-hour chart, each of these candles represents that specific time period. And the way you want to look at this is this. The entire price move that's happened during this candlestick is from the top of the wick to the bottom of the wick. Now, the body of the chart is key because this bottom left on a green candle represents where the price opened for this time period. And the top right of the green candle will tell you where the price closed for that time period. You can apply the same thing to the red charts. Now, the red charts means price moved down. The left top bar will represent the opening price, and the bottom right corner will represent the closing price. So those are a couple key things to keep in mind when it comes to price charts. Now, let me go into a couple examples of price charts with these charts right here. Now, here we're looking at a chart of Ethereum versus the US dollar, and these candles represent 15 minutes of time, and this is on the Coinbase exchange. And the first thing you'll notice is that candlesticks come in many shapes and sizes. Here's a big down candlestick in red. Here's an up candlestick in green. Here's one that's all wicks right here. But one key type and behavior I want to point out is known as the bearish engulfing candle. Now this happens when the price of the new candle goes higher than the price of the previous candle and then closes below the low of the previous candle. So this is a bearish engulfing pattern, and it usually signifies that prices are going lower. And the reason for this is you have to put yourself in the shoes of the other market participants or the investors. Let's say you were an investor that bought this green candle here expecting price to go higher. Now all of a sudden, this big seller walks into the market and knocks the price down lower. So if you had bought here on the expectations that prices would continue trending higher, now you're looking at more sellers, and so that's bringing out more people who are selling because now prices have reversed. On the flip side, we have the bullish engulfing candle. Now this is a chart of Bitcoin versus the US dollar. Each of these bars represents 240 minutes, which means 4 hours of time, and this is on the Coinbase exchange. Now a bullish engulfing candle is similar to a bearish engulfing candle, but it signifies that prices are ready or perhaps might be moving up. So right here you have a red candle, and the next one, this bullish engulfing candle, actually drops below the price of the preceding candle and then closes above it. So it closes up here. And this signifies to other market participants and other traders that prices might be rising. And just as you're looking at, prices did rise over time. They went up. This candle closed at 6,000, and then by the next day, prices were at 6,700. So these are two simple ways to use candles to identify changes in price. Now, when you think about technical analysis, it's going to show you a chart and the price trends in that chart of the asset. But you also have to think about technical analysis as understanding the behavior of the market participants. Now, we've seen over different market cycles and asset classes that charts and prices are determined by people's beliefs. And humans have the same greeds and fears no matter what the asset class is. Whether you're trading the stock market or the crypto market, those fears and greeds will always be the same. So over time, we've used technical analysis to give us not so much a prediction, but more information as to where prices might be heading next. So there's a couple simple chart patterns that I want you to know about. And I'm going to start by the double top and the double bottom. Now, in a double top, a price has been reached, then the price drops, hits that same price again, and falls. That's a double top. The double bottom is just the reverse of it. The next simple chart pattern is the head and shoulders reversal. And this happens when prices reach a new high, they drop, and then they fail to break that previous high. So it looks like a head and shoulders, and I'll show you what that chart looks like in a second. And lastly, you've got the rounding bottoms. Now this chart is an accumulation period, and it's usually when there are buyers moving into the market that aren't letting the price decline, and it usually turns into a big bull move in the chart. Now, let me look at a couple of these charts to show you an example of what I'm talking about. The first chart we're looking at here is a chart of Bitcoin versus the dollar. It's a 15-minute price chart on the Bitfinex exchange. Remember, each of these candles here represents 15 minutes in time. And what you'll notice is that in this short-term period, prices sold off and hit a double bottom. The price of Bitcoin dropped below 9,300 right here. It rallied and then sold off and hit a double bottom. So anyone who's trading this noticed that the downtrend looks like it was reversing, so they came in and bought and pushed the price higher. That's indicative of a double bottom. Now, a double top is exactly the opposite. And this is, again, a 15-minute chart of Bitcoin versus the dollar on the Bitfinex exchange. So in this case, the price of Bitcoin rallied to 10,500, then it sold off, and then bounced back to 10,500, forming a double top. And then immediately after that, you had a huge drop and a downtrend. And so that's a double top. Next, we've got a head and shoulders. And this one has been pretty predictive in the Bitcoin markets. And there's a couple things in head and shoulders that I want you to notice. First, when Bitcoin breaks to a new high up here, this is considered the head. Now, as it sold off and it bounced again, it formed this pattern that looks like a shoulder. That's why we call it a head and shoulders. Here's the head, and here's the shoulder. Now, the key level here is the neckline. And the neckline starts from the first bounce. So when Bitcoin bounced at 12,774, it formed the neckline. And you'll see once this neckline was finally broken, prices dropped very rapidly. So this is a $3,000 drop in Bitcoin. And then it bounced. But what's key about this chart is that what once was support at this neckline then turns into resistance. So you can see there was a battle going on here with the buyers and sellers. So this was support during the neckline, but once it was broken, it became resistance. Prices were unable to get above 12,774. Another chart of Ethereum head and shoulders. This is Ethereum versus the US dollar. You've got a one-day time frame for each candle. This is on the Coinbase exchange. And this is the head, and this is the shoulder. And you can see prices drop down here to this neckline. Same thing that we saw in the Bitcoin chart, where when prices finally dropped below the neckline, there was a big flush followed by a rally. However, this area here at 983, which was once support, now becomes resistance. So people who were once buying at this point are trying to sell because they were buying at support, accumulated Ethereum, and now they have some to sell at the same price. So that is a classic head and shoulders pattern. Now lastly, I want to show you what a rounding bottom looks like. Rounding bottom is indicative of prices moving higher, and you can see there's a little bit of a curve to this as it's trending higher. And what we've seen with rounding bottoms is when they finally break to a new high past the old high. So the old high here happened in June of 2017, when the new high in this Bitcoin versus dollar was finally broken in December. You saw what's known as a parabolic move. So as soon as the previous high was broken, then buyers quickly rushed into this market and sent the price higher. So those are just a couple simple price charts that you need to be familiar with when you're looking to analyze the crypto markets.